Welcome back, everyone. This is Not Your Advisor with NYU Grad on Monday, May 6th. Hope everyone had a great weekend. We have a lot to cover today, so let's jump right into the breadth numbers. Very positive, bullish action. I would say just off the bat, the only thing missing here is volume, and we'll talk a little bit about interest rates and the yields. But the numbers are the numbers. We had 528 new highs versus 88 new lows for the day. 72% of stocks were advancing versus 24% declining. 45% of shares were below its 50-day, and 34% were below their 200-day moving average. The Dow closed up 176 points, about 0.46%. The NASDAQ closed up 192 points at the high, up 1.19, and the S&P was up 1%. Taking a look at the mega cap land, you had pretty much every single Mag 7 green except for Apple, with some pressure with, no doubt, the Warren Buffett sell news. And we'll talk a little bit about that as well. But Microsoft was up 1.7%, Google was up 0.5%, Meta was up 3%, Nvidia was up 3.77%. All of the semiconductors caught a bid. You are now also seeing all of the tech software names V-ramping, basically a continuation of last week's Apple's massive buyback announcement. In healthcare, you had Eli Lilly making another positive move, but a few others were red, like Merck, AbbVie, and J&J were basically down about 0.5%. Amgen was down 3.79% after their huge rally late last week. So that kind of gives you some complexion on mega caps. Looking at sectors, every sector was green today. Technology led the way, up 1.5%. Financials were up 1.2%. Pretty much everything was up about 1% until you got to utilities. So utilities did not lead for once, which was healthy for a bullish move. Now, today's episode, I'm going to give a free introductory lesson on auction market principles and market profile, in hopes that you will come over to the paid side to kind of learn what a lot of the premium members are learning of late. But before I jump into it, I also wanted to give a quick shout out to a Substacker that I just found, Capitalist Letters. And I found him through the way of a post he put out over the weekend, 10 lessons from the 2024 Berkshire Hathaway annual shareholder meeting. I watched maybe 90 minutes of it. It's a 7-hour meeting, and I did not want to actually watch it because, I have other things to do, and I have watched it in the past. But Capitalist Letters did an excellent job with the 10 lesson or takeaways. I would highly recommend you read this post or Substack. I will include it in the show notes here. Just a little bit of housekeeping before we start jumping into the lesson. I sent an email out to a small group of free subscribers, curiously, who have never opened an email from me in the past 6 months. So I guess if I'm going to the spam filter, they're not going to get the email. But if you're listening to the podcast and you've never gotten an email from me, or you don't recall getting an email from me, I might be going to your spam filter. So let me know, DM me or message me through Substack. Let me know if you're not getting my emails after subscribing. And another thing I want to do is basically every quarter, I'm going to go into the dashboard and look at folks who did subscribe but have not opened any emails for the past 6 months. And just as a courtesy to your inbox, I'll just unsubscribe you to keep the clutter away. And then you can always just hop back in and subscribe if you didn't want that to happen. Or let me know for whatever reason you just rather stay on but just don't want to read the emails. Just let me know and I won't remove you from the list. So let's keep going. They often say how simple someone can explain a concept usually shows their level of mastering that subject. So here goes. I'm going to actually repost in the show notes the actual full lesson in its entirety. It's called Market Profile Charting for Dummies Remastered. Now, that does sit behind a paywall, so you won't be able to read the whole thing if you're a free subscriber, but it's there for you to kind of preview like 1/3 of it. And if you were curious to continue, you can upgrade. But my basic explanation and 101 lesson for this from market profile charting is really simple. Stock prices or prices of anything, whether it's Air Jordans, a Porsche, a Rolex watch, prices of anything in auction, a marketplace, are either in one of two stages, to keep it simple. Number one, the prices are in balance, which basically means they're trading in a range of $10 and $20, let's say. I'm just using this as an example. And it facilitates trade between buyers and sellers for the longest period of time or volume, depending if you're looking at market profile charts or volume profile charts. The other stage for prices of anything in a market is out of balance. That's where the price range does not meet sufficiently the demand of buyers or sellers, and prices have to move violently above or below that previous range. And that's really it. Simple as that. If you go into the full details of market profile charting for dummies, not only will it explain why this happens, why this bell curve continues to happen in every time frame across all asset classes, it will also kind of show you how a market profile chart is calculated and created and how to read it. But I'm going to give you a quick sneak peek here. So I have a photo from this past weekend here in New York. This is a photo of the Woolworth building. At one time, this was the tallest building in the world in downtown Manhattan. And if you've been following me, you'll know that I have a semi-photographic memory and a very associative memory. And once I learned about market profile, I literally just started to see market profile charts everywhere in my natural world. And now whenever I see buildings, I see market profile charts. So if you turn the building sideways, you'll see the bell curve, and you'll see the distribution of this bell curve. And typically what happens is the tallest building, which represents the most amount of time for a thing to be priced at. So let's say the middle range was $15 and the bottom was $10 and the top was $20. Prices typically will trade as close to the middle as possible for the longest amount of time, because that's where a lot of people are going to agree on the price. It doesn't have to be directly in the middle. Sometimes it's a little offset, higher or lower. It doesn't have to be in the middle, okay? I'm just giving you just 101 basics here. And that price is the high volume node, and that acts like a magnet, and you'll typically see prices violently go through it up and down, and basically going to the edges of these price ranges. And if you look at the edges of the range, prices don't spend much time there. It's rare. Unless they're getting ready to leave that area, they typically kiss it and then violently get bounced to the other side of the balance area. Or they'll kiss it, form a little mini balance area, and then break out up or below it. So that's really it. That's my 101 summary elevator pitch on market profile charts. But I hope you take a look at the full post and upgrade and join us. And I'll leave you with, or I'm not going to leave you, but I'm going to also leave a visual example, and I'm not picking on Starbucks, but I'm going to use this because it demonstrates it really nicely. So this chart encompasses Starbucks right before the COVID lockdown, and you can see the V bottom that it created in 2020. But pay attention to these price ranges here. And the first one in red, I tried to color code each one differently so you can see them, is about a year. The long one in purple is about 18 months. But real simply, for the year in the red balance area, there was an agreement between buyers and sellers. There was one episode in the middle of it where it tried to break out into lifetime highs and they failed. So it came right back into the balance area, and look where it bounced. It bounced right at the high volume node. It tried to break out again, and then it failed, and then went all the way to the other side of the balance area. But it kept getting defended there. It once failed to the downside. Do you see that? But then it V bottomed back into the balance area, and it almost went to the other side. So this is just basically the market facilitating as many sellers and buyers of a thing. But once the range cannot sustain these transactions anymore, it violently moves out. And that's called an initiative move. And this violently broke down. And it went from $110 to $65. And you can see here it's a light yellow range, but it carved out a smaller balance area, and then it broke out of that, and then it carved out another one, and then it broke out of that, and it carved out another one, and that one lasted over a year. But it's a messy one, and as you know, they reported earnings last week, and it wasn't too pretty, and it crashed. It went from like $90 to 74 or $73. So what's basically happening is it's out of balance. Prices are now seeking a new area where the majority of buyers and sellers can facilitate trade for a while. So it's seeking balance. We don't know where it's going to flush out. There's no point in guessing, right? And you just wait until buyers and sellers agree for, whatever time frame you want to trade this. So hopefully that made sense. A lot of the paid members are getting this, and they're really understanding it. The beauty of my Substack is my paid subscribers are now able to do this and fish on their own and come back to me with ideas for just another set of eyes or a gut check. And that's the whole point of this Substack that I've created. I want to teach folks how to swim. There's a lot more nuance to this than just drawing boxes. I guarantee that. But again, I'm doing a elevator pitch 101. If I had to teach someone that has never had a brokerage account, has never traded anything. So that is just a introductory 10-minute overview of auction market principles. So let's keep going here. Let me kind of cover what stood out to me. So around 2 o'clock, there was hardly any volume, not hardly any, it was like half the volume of typical SPY average daily traded. But around 2 o'clock, I had posted on Substack notes, there's your intraday rally. It's all tied to the 10-year. So all I did was I mirror flipped and inverted the 10-year yield chart, because the 10-year yield was rising and then it started to sell off. So I just flipped the chart upside down and then horizontally, and you can see tick for tick, like the time bar, that's where the rally came from. Yield started to get sold off. The dollar started to go down, and risk assets went higher. That's all that happened today. And the riskiest or the most crushed equities were the ones that bounced the most today. So that was kind of the summary there. Palantir reported after earnings, and they were up 8% during the cash session, and then they're now down 8% after market hours on the earnings. So, they front ran Palantir. Everyone was anticipating it getting in, and it got sold off after the earnings report. Very similar with Microchip Technology, MCHP. They were up 2.6% during the cash session, and they are now down 4.76% for after earnings. What else stood out to me? So I'm going to go through what was strong, what was weak. The strong list is very long, okay? But I want you to take note of the quality of the names. These are all percents. A lot of them either V-bottomed or they're still under the 50-day moving average, which is bearish. But here we go. Marathon Digital up 17.9%. Fresh Pet up 10.45%. Palantir up 8.06%. I covered that. Wayfair up 7.6%. VinFast Auto 6.5%. SMCI 6.09%. Bitfarms 5.49%. DraftKings 5.38%. I think they reported already. I'm not sure. I'll have to double check. ARM up 5.19%. Etsy up 4.1%. Shopify up 3.9%. Nvidia 3.7%. MicroStrategy 3.74%, SLV 3.5%, Reddit 3.4%, Hovnanian 3.48%, AMD 3.4%, Pan American Silver 3.4%, New York Community Bank 3.4%, Dell 3.3%, Toll Brothers 3.3%, Dash 3.3%, Uber 3.29%, Klaviyo 3.29%, BITU, a bullish Bitcoin ETF 3.23%, NetApp 3.16%, Affirm Holdings 3.12%, Meta 3.04%, Netflix 3.04%, AI 3.04%, Kava 2.97%. So the whole list is there for you premium members, but I'm not going to keep going on. I'm going to run out of, I'm going to start going out of, I'm not going to be able to talk anymore, like right there. So I'm going to pause. It's a long list of green. What was weak? Anything that had short bias to it. Natural gas was actually down 2 point something percent. And then Apple, I mentioned, closed off a little bit. Now, the whole thing with Berkshire Hathaway reducing his position, that's smart of him, right? He felt he was too overweight on Apple. It's still one of his largest holdings after the reallocation or reduction in size of his position. But yeah, I mean, on the buyback news, smart money should be selling, and the retail buyer is buying. So we'll see if they keep unwinding the buyback news and if we get back to the pre-buyback news price on Apple. For free members, there's going to be tons of earnings coming out this week. I typically do not trade earnings. It's just too crazy, especially when things could potentially be overbought right now. But if you have favorite stocks, they're all probably reported or reporting this week. Keep watching tech layoffs through TrueUp.io. I've been tracking credit card delinquencies. They're starting to really creep up. And the true rate of unemployment, which I've linked in a past post. Thank you for tuning in. Check out the market profile for Dummies post, and I'll see you all after the Tuesday session. Paid members, please stay on.